Welcome investors to Joe's Investment Express. I'm going to talk about fishing today, and then I'm going to connect that to investing. And specifically, I'm going to talk to you guys about not bottom fishing, and I'm going to explain why. And if you want to skip to how it pertains to stocks, that's okay. I will put a mark on the, I'll put a timestamp down there for you. And of course, this is not investment advice. I'm just talking about fishing and providing a little education. So I grew up in Montana and Bozeman, Montana, and I did tons of fishing during my childhood with my dad, with my friends. We fished on the Yellowstone, the Gallatin, the Jefferson, and then lots of smaller creeks too. And the most fun and by far the most effective was when we were dry fly fishing during a hatch. And the fish should be taking bugs off the surface, and you lay your fly out there nicely, and whammo, right? Fish would hit your fly, and sometimes they were small and sometimes they were big, but it was pretty easy. But sometimes you go fishing and nothing was biting, and you didn't see any rises, nothing was striking at your fly, and eventually you would have to switch to fishing wet flies or streamers, aka bottom fishing. What happened when you were bottom fishing? Well, every once in a while you got a big one. The biggest fish are often sitting down there on the bottom of the river. But you know what usually happened? Usually you got your fly tangled up in moss or algae, or it got caught on an underwater stick, or got caught on a rock, and you'd have to wade out in the middle of the stream and dig it out of there. Or you'd have to yank on it and you'd break off your fly. And that happened over and over again. And really, bottom fishing is really not that much fun. So how does this relate to stocks? Well, let me turn on my screen here. So I don't like bottom fishing at all when I'm fishing. And I don't like bottom fishing when I'm investing in stocks either. And I know a lot of you guys, that's exactly what you've been doing the last few weeks or months. You see these stocks, like poor Peloton here, that are beaten down, and you say, well, it was at 130, now it's at 12, it's the same company, and it's a much better value down here, so I'm going to buy it down here. But what happens? Metaphorically, your fly gets caught under a log, right? And you lose your fly. Specifically, here's the problem. So here you see Peloton. This thing's in a downtrend, and certainly you can buy it and play a little swing trade, a little 1 or 2 or 3 or even 5-day swing trade. But the problem is all of these trapped buyers. These guys are all trapped buyers and potential sellers, and they are mad as a hornet. That's the first problem. The second problem is the bottom fishers that did get lucky and did catch the bottom, they are thanking their lucky stars, and they are looking to get out. So as this thing goes up to 15, this is a natural resistance point, and these guys that bought it at 12, and girls, they're going to be looking to sell it. And the same thing happens when it hits the 50-day. That's a natural resistance point. These bottom fishers are going to be unloading shares there, and the smart money is going to know that there's potential resistance there, and they're going to get out. Look at 20. Here you've got another line of resistance. These trapped buyers who bought at 20, this guy, right, he was so proud of himself for buying at 20, rode it to 30, rode it all the way down to 12. What's going to happen when it gets back to 20? He or she is going to get out and thank their lucky stars. And that's going to keep happening all the way up. It's going to happen at 30. It's going to happen at 40. It's going to happen when it hits the 200-day. It's going to happen when it hits this gap at 60. It's going to happen when it hits the top of the gap at 85. So you've got potential sellers all the way up. And maybe the stock is undervalued now, but it doesn't really matter. You're not buying an automobile, right? That you're not buying a Chevy Corvette from the 50s that was at $100,000 and now it's on sale for $25,000. No, you're just buying a piece of paper, and the only value that these things have is the value that other investors are willing to pay for them in an auction. So with buying these stocks in downtrends, you're swimming against the current. And yeah, you definitely can swing trade them, but to buy this thing down here at 12 and think it's going to go to 130 again, that might take weeks or months or years. It might never happen. The old leaders are not the new leaders. Let me repeat that. The old leaders are not the new leaders. The new leaders are. So what you want to do is you want to dry fly fish on the surface. And here's an example. This is LNTH. This is my highest conviction play. This is my largest position. This thing is breaking out to new highs. There are no trapped buyers up here. There's nothing up here but rarefied air, and the sky is the limit, so to speak, and it's going up. What do stocks that are going up tend to do? They tend to go up. What do stocks that are going down do? They tend to go down. So in conclusion, when you look at these past leaders that are way cheaper than they used to be, don't get tempted into bottom fishing. Instead, look for stocks with a relative strength of higher than 90 that are at new highs or near in bases and making new highs. And dry fly fish these things. All right. Okay, well, let me know what you think about this, and if you want to tell any fishing stories or talk about fishing in Montana, just put your comments in the comment bulletin board below. Take care, everybody.